Hey traders, Desmond here from IronFX. Let me ask you a question that sounds simple, but it quietly decides whether you trade with confidence or trade in confusion. How many time frames should you use when you analyze a chart? Because if you have ever loved the setup on one chart, then zoomed out and suddenly hated it, you are not alone. Here's the thing. Too few time frames and you are trading half blind. Too many time frames and you freeze because every chart tells a different story. Today, I want to give you a clean rule you can actually stick to, right? So you stop second guessing every trade. Think of time frames like Google Maps. The higher time frame is the zoomed out view. You see the highways, the big direction, and the major traffic zones. The lower time frame is street view. You see the exact lane changes, the potholes, and the stop signs, right? If you only use street view, you get lost, right? If you only use the zoomed out map, you miss the exit. My hot take is this: most retail traders should use 2 to 3 time frames, right? Not 5, not 9. 2 time frames if you want it simple and you tend to overthink, right? 3 time frames if you want structure and confirmation. More than 3 is rarely more edge. Most of the time, it is just more noise. Here's the simple 3 time frame model. 1 time frame for direction and key zones. 1 time frame for your setup, and an optional lower time frame for a clean trigger. The goal is alignment, not perfection. You are not hunting the perfect entry. You are checking whether the bigger picture and the trade idea agree. First, the higher time frame. This answers where are we in the big picture. You mark major support and resistance. You decide if the market is trending or ranging, and you identify the zones where price tends to react. If you day trade, this is often the 4-hour chart or the daily chart. If you swing trade, it is often the daily chart or the weekly chart. Second, the trading time frame. This is where your strategy lives. This is where you say, do I actually have a setup, yes or no? Day traders often execute on the 15-minute chart or the 1-hour chart. Swing traders often execute on the 4-hour chart or the daily chart. This chart decides the trade idea, not your emotions. Third, the optional lower time frame. This is not for changing your mind, it is for improving execution. You look for a clear trigger like a rejection candle, a momentum shift, right? Or a small structure break that shows buyers or sellers actually stepped in, right? If this lower time frame makes you panic, skip it. A slightly worse entry is cheaper than a broken mindset. Let me give you a practical example using Euro-Dollar. On the daily chart, price is in a broader uptrend, pulling back into a prior support zone. So your bias is simple. You prefer longs from support. On the 1-hour chart, you see price basing and selling pressure fading. That is your setup. On the 15-minute chart, price dips below the zone, snaps back, and closes strong. That is your trigger, and your stop can sit below that sweep low. Now, here is a mistake I see all the time. Mixing signals from different time frames, right? So the daily chart says buy, the 1-hour chart looks messy, the 5-minute chart spikes down, and you bail out. Then the market moves exactly as the higher time frame suggested. So here is a rule that saves money. 1 time frame decides the bias. 1 time frame decides the setup. Anything lower is just execution detail, a quick guide for picking your stack. If you scalp, you might use the 1-hour chart for direction, the 5-minute chart for the setup, and the 1-minute chart for the trigger. If you day trade, you might use the 4-hour chart for direction, the 1-hour chart for the setup, and the 15-minute chart for the trigger. If you swing trade, you might use the weekly chart for direction, the daily chart for the setup, and the 4-hour chart for execution. Final point, you are not trying to make every time frame look bullish or bearish at the same time. Markets brief, you are looking for alignment between the big picture and your trade idea. Then you execute with discipline. Zoom out to make the decision, zoom in to place the trade. And do not zoom so much, you lose your nerve. All right, that's it for today. If you tell me whether you are a scalper, a day trader, or a swing trader, I will give you a clean time frame stack to use, plus exactly what to look for on each chart. This is Desmond from IronFX. Trade smart, keep it simple, and I will catch you in the next episode.